Hi everyone, I'm Adam Thurgood, Managing Partner of Hightower Las Vegas, and I wanted to spend a few minutes today with you to discuss gold. We've seen a lot of activity in the gold market in the past couple of weeks, and we'll get into that. But if you've watched our client briefings over the years, you will have noticed the theme, which is that we are generally very positive about holding gold in portfolios for a variety of reasons. Obviously, you want the price to go up, which we've seen recently, but more importantly, it is a great diversifier in portfolios because it has almost no correlation to both stocks and bonds. So what's been happening with the price of gold? Well, over the past couple of weeks, we've seen it surge to new all-time highs. It's hit a price of roughly $2,300 an ounce. That's up quite a lot, especially from the 2015-2016 level. And if you zoom out and look at a big long-term chart of gold, what you'll notice is that it's forming what's called a cup and handle formation. Now, we don't rely too heavily on pure technical analysis, but we do reference it, especially when big patterns start to develop. So let me explain what a cup and handle is by overlaying a cup and handle on top of this chart. You basically have a big surge higher in the price of an asset. It then declines rapidly and goes sideways for a period of time, then reclaims those highs that it had hit previously, but then goes sideways again for a period of time before breaking out higher. And when you do see a break positively from a big long-term cup and handle position, it's very structurally bullish for the asset from a technical perspective. So why is gold going up the way it is right now? Well, we think there are a few factors. And one is that the Fed looks like they might be ready to pivot and start cutting interest rates despite a fairly robust inflationary environment. If you look at the top pane here, this is core CPI, which is one of the most widely watched inflation measures. It bottomed out on a 3-month annualized basis last summer and is now increasing at about a 4% pace. Now, the bottom pane shows super core CPI, which takes core CPI and removes the impact of housing. It also bottomed last summer and is increasing at over a 6% 3-month annualized pace. These numbers are way above the Fed's target of 2%. So if the Fed is going to be cutting rates while inflation is still running well above their target, that's going to be an environment that gold does very well in. And so we think that gold is kind of sniffing out this policy pivot that might be headed our way as early as June. Now, unfortunately, on the inflation front, it does look like we might be following a similar path to the 1970s. Back in the 1960s and 1970s, we saw a little bit of a blip in inflation, and then it cooled off, and then we saw a big spike in inflation, then a big drawdown, and at that point in time, the Fed took their foot off of the brakes, and inflation started to build again and reaccelerated to really high levels during the early 1980s, late 1970s. And that gold line here is what's happening now since 2013, mapped on top of what happened in the 1970s. So if the Fed does take their foot off the brakes here, it could spark another wave of inflation, which would be detrimental to the economy. And gold is one asset that should help protect from that outcome, which is potentially why it's moving right now. It might see this as a strong possible scenario playing out. Another reason to be bullish gold more on a long-term basis is that central banks have become very big buyers of gold. Back when the Cold War ended, we saw central banks start to sell off their gold holdings as the world became a safer place and the US was the dominant power. But since the financial crisis, we've seen central banks really start to buy more and more gold and hold it as a reserve asset on their balance sheet. And this trend was even magnified more so once Ukraine was invaded by Russia. And it's not so much that the Russians invaded Ukraine that caused central banks to buy more gold. It was really about how the West responded to Russia. Led by the US, along with Japan and Germany and the UK, we seized Russia's foreign central bank reserves that were held in treasuries and other government bonds, taking hundreds of billions of dollars away from them for their access to operate the country. And that sent a message to other central banks and governments around the world that, hey, if you get on the wrong side of the US or its allies, they can easily just freeze or seize your treasuries. And so we've seen central banks start to move away from buying government bonds and into more of a neutral reserve asset like gold. And unfortunately, I don't think that trend is going to go away anytime soon. I think when the history books are written decades down the road, that policy move will be viewed very negatively because it really weaponized not only the dollar but also foreign central bank reserves held in treasuries. And we could spend a whole day talking about why this might be structurally bearish for the dollar, but we'll save that for another day. Another reason to think that the structural setup is very bullish for gold is just because of the difference between the growth in the supply of gold and the growth in the money supply. If you look at the boxes that are highlighted in yellow, you'll see that that's the supply of gold going up every year by about 1.5% to 2%. It doesn't fluctuate that much. Even if the price of gold surges, the supply of gold doesn't go up that much. It's tough to mine more gold than 1 or 2% a year. But the green highlighted boxes, or the green circled boxes, show the money supply growth. And you can see that other than a few really bad periods where the money supply growth fell, like in the Great Depression, it's been going up and going up at a much faster pace than the price of gold. In fact, over the last 30 years, the money supply growth has been over 6%. So from a very basic perspective, if the supply of gold is going up by 2%, but the money supply is going up by 6%, then the price of gold should adjust higher. So we think that there are lots of reasons to be bullish gold. It's produced a great long-term return over the last 50 years, about 8% on an annualized basis. It does not go in a straight line, but again, that provides diversification benefits to portfolios. So we are still structurally bullish on gold. We think that there is a bright future for it until the world's governments become more responsible and stop spending money like drunken sailors. The money supply should be increasing at a faster pace than the supply of gold. And we do think that central banks will continue to be buyers. And those structural forces are great tailwinds for gold. Now, that being said, we may trim our position here a little bit because a lot of accounts are now overweight. But we do believe and continue to believe that gold is a very important asset to hold in portfolios. Well, that's all that we have for you today. As always, you can find us through email or phone to ask any questions, and we'll see you next time.